Welcome everyone. Looking forward to going through this session. As I see from the poll results, it looks like there's quite a few of you that should hopefully get a lot of value out of this. I'm going to share my screen and put up a slide presentation here. All right, perfect. You guys should be looking at it at this point. So my name is Kevin Brocklin. I'm with Indelible Ventures. I'll give you a little bit of background in regards to Indelible first off. So Indelible Ventures is a seed stage venture fund. We're focused on tech-enabled B2B products that can scale internationally. As I said, I'm Kevin Brocklin. I'm the managing partner of Indelible Ventures. A little bit of background on myself. I've managed collectively over 500 million in assets, worked with some of the largest institutional investors. I've invested and dealt with hundreds of companies across continents, across countries, and have helped many of those companies to scale internationally. So this is going to be part of a broader series. So this is the very beginning. So essentially, we're going to try and walk through several of the pathway topics of preparing for funding before you start going out and raising it. Next week, we're going to talk about investor pitch decks and business projections, and then getting into some deeper conversations of topics of once you've already found investors and so forth. So yeah, preparing for funding, how to plan for an ask before you actually need it. I know a lot of entrepreneurs are very curious of what to actually do in this regard. Unfortunately, the venture capital industry is a little opaque. And so a lot of these sort of best practices and tactics are not necessarily well marketed or otherwise. So hopefully you guys will get a lot out of this as I go through these suggestions and so forth. So the starting point to all of this that I would suggest is when you get ready for fundraising and you know that you're going to need to do fundraising, start early, because anyone that's gone through this can likely tell you that it will be more difficult and take longer than you think. Many people will tell you that it requires a rather substantial amount of time on behalf of the founders. And so the key piece of advice that I would put out here first and foremost is to start early and be prepared and be organized, because a well-laid plan will make it that much easier to be efficient with your time, efficient with your resources, and increase the odds that you'll actually have a successful conclusion when you do actually go out and fundraise. And hence the tacky photo of the cat there that I just couldn't help but put in. So let's break down the initial thought process here in regards to what you should consider at the very beginning of endeavoring upon this. So when you look at that initial thought process, I highlight three key aspects here. First, you want to know what you want, when, how much, and for what. If you don't know what you want, how much money that you want, when you need it, how much, what purposes, all of that, you don't have the initial building block of being able to go out and do a successful fundraise. So first and foremost, you want to figure out what is it that you actually want. And I do need to note that it's not necessarily just money. I'll dig into this a little bit more in a little bit. Number two, you want to know who you want it from, and not just who, but why do you want that entity or individual or whatever as your source of funding. And then lastly, you need to know what they are going to be looking for. What do they want to see out of you in order to make that investment decision? So if you can cover all of these three thought process and have a well laid out plan, that is your fast track to being able to effectively run a fundraising process. So let's start at the beginning of these thought processes. It all starts with a plan. you need to be able to put together a plan. And next week we'll talk about business projections. So I'm not going to delve so far into that, but you need to have that plan so you know when is the timing aspect. When do you actually need the funding? You don't want to go out and raise money when you're already running out of money. If you're going to run out of money in 2 weeks, that's not so good to be able to go out and do fundraising, because it's going to take you longer than that, chances are. I know a lot of you are probably in the very beginning stages looking for pre-seed or seed stage funding. So you're probably bootstrapping at this point. So when do you need funding? Yesterday. But realistically, you need to be able to have an understanding of the timing relative to the business, relative to when you realistically think that you could raise, and so forth. How much funding do you actually need? Putting an actual value on it. And what does that actually mean? There's a lot of companies out there that'll just like throw out a really high figure, but you need to know for what will you spend it on, and you need to be able to justify rationally what that fundraise is going to be. And there's some general rule of thumbs that when you're looking at early stage, a lot of investors will say, okay, I'm looking to give you, say, 18 to 24 months of runway. That limits their risk exposure to make sure that you're given sufficient enough time in order to start scaling up for your next raise. So there's some considerations in regards to that you'll want to take into account when you're planning what is it that you actually want, how much, when, and for what. So let's dig in a little bit more. Again, I'm not going to go so deeply into business projections, but at the high level, you want to be able to have the initiation of saying, okay, what is the opportunity that you're taking advantage of? Is it a market inefficiency? Are you creating a new category? Is there some sort of market trends that are pushing it, that is creating this opportunity? If they're time-based, that plays a big role into understanding how you're rolling out your strategy, how you will actually take advantage of this opportunity. That it starts involving into understanding the underlying tactics. When you understand the underlying tactics, that's the implementation. That's when you start getting further into the considerations of what are the resources that you require in regards to headcount, in regards to other costs, tech build out. All of these different sorts of things are the resources that are going to put demands on your cash flow. And when you lay those out and you have a realistic plan of the resources that you can acquire, then you can start looking at, with these resources, what sort of revenue acquisition can I actually feasibly accomplish. And those are the initial building blocks of your plan. Again, we can dig further into it when we talk business projections next week. But that's kind of these are the building blocks of the what do you want, when do you want it, and what do you want it for. So some simple advice, because since I'm not going to go all the way into every single detail, some simple advice, because planning can be complicated. So do absolutely know your market and your value proposition to them. If you don't have a solid understanding of your market, it's going to be very difficult to really understand what your value proposition is to them. So you need to be able to clear that up and be able to clearly define that. And that's ultimately going to land into your pitch deck. That's ultimately landing into your business projection. So it's very critical that you have a solid understanding of that. And don't forget that your market may actually have more than one side to it. So you need to understand the different sides of that. If you're looking at a marketplace model, you need to understand the different sides of that marketplace, and understanding those different sides, what your value proposition is to them, how you're prioritizing, etc. Do know your go-to-market strategy. I imagine that a lot of people that are here are probably in the very earliest of stages. So you may actually already have initial traction, but you need to understand what that go-to-market strategy is in order to continue to grow that revenue line, to grow that product market fit. What's that go-to-market strategy? Because that's going to help drive your understanding of the resources that you need and what type of funding you need in order to be able to afford those. Don't ignore that there is competition. There's not very many companies out there that are creating brand new categories. So there's someone, whether it's an existing competitor, whether it's a tangent, whether it's a substitute, there's many forms of competition. So don't ignore that it exists. I'm not saying build your strategy around a competitor-centric approach, because honestly, I prefer more like the Jeff Bezos thinking of the customer-centric approach. Focus on delighting your customer, and you will get a leg up on the competition by doing that. But again, when you're putting together your market, when you're putting together your go-to-market strategy, don't ignore that there is competition. Yeah, this one's quite important, and I see a lot of companies that don't adequately do this. But you do need to know your milestones and your critical KPIs to know you're on track. These are basically your roadmap. So when you're putting together this grand strategy of what do you want to accomplish in 1 year or 2 years, these milestones and KPIs that are periodic, whether you're creating them weekly, monthly, quarterly, these are your flag points over the course of time that allow you to know whether or not you're on track. And if you can adequately set these, it's going to give you better information in regards to the costs required in order to get to this. What are the outcomes that is going to end up driving? So don't get lost in the aggregate, because the details are what actually make it. I don't want you to get overwhelmed with so many different measures and so forth, because there is value around the whole one metric that matters mentality. But that one metric, when you think of it, it can be broken down into subcomponents and subcomponents. So it's good to understand what those are, because just focusing on a top line revenue, it doesn't tell you what you actually need to do in order to get to that. But knowing your milestones and your KPIs will give you better insight into that. Do absolutely prepare a cash flow statement, ideally monthly. I've seen some people create it with a higher frequency, but certainly, monthly is something that you're going to need to show so that you can have an understanding of the inflows and outflows. To do this, you're going to have a solid understanding of what your collection cycles are. Depending upon what your product is, you may collect cash right at the time of sale. You may have 3-month collection cycle where you provide services, extend all of the costs, but don't collect money for some time. You may have subscription services where you're collecting advance payment in advance, which is fantastic for your cash flow. But understanding all of that gives you better insight into understanding how much you actually need to raise, when the timing trigger points are of when you need to raise, and gives you clear idea in regards to all of those points. But don't make unrealistic forecasts that are impossible to achieve. If you do go out and try and fundraise with impossible, unrealistic forecasts, you're not going to be successful. You need to have something that is realistic. Even if it's optimistic, it needs to be realistic. You need to be able to show that whatever you're planning on doing, you have a high probability of achieving. And so what does this all boil down to? You need to know your cash needs and how long it will last you. I referenced earlier about understanding your cash runway, of how long cash will last you, and the rules of thumb that some investors use in regards to 18 months runway, 24 months runway. You need to know what your cash is going to last you that you have right now. You need to know when you're trying to set an amount of money that you're going to raise, you need to know how long that's going to last you, so that you can understand when you're going to end up having to raise again. So don't plan to the short term or think you will never have to raise again, because most companies will end up having to do multiple fundraisers. When you look at any of the $100 million if you look at really any company that's of any substantial size, they've raised multiple times. So you need to know what your cash needs are, how long it will last you, and you need to leverage that in order to be able to plan for the fact that you may end up having to raise multiple times. So that's kind of the basics on some of that initial planning. So let's talk about who you want it from. And so I get the tendency that oftentimes when somebody goes out and fundraises, they just want anybody and everybody to try and fund them, and that's understandable. But realistically, you want to be selective, because this is not just about the money. I know fundraising is about the money, because there is a component, but it's not just about the money, because this is your business, this is your passion. You became an entrepreneur for a reason. So keep that in mind, that any sort of funding source that comes in, any type of investor that comes in, they may just bring money. That's fine. That's a type. If you consider that what you're targeting, you may want somebody that has some additional value add. And so have a consideration when you're looking at it, and understand that it may not necessarily just be about the money. And by thinking that through of what you want, it'll help you get a better handle on it. So starting to talk about the process. So that's kind of the intro of this section of who you want from, to understand that there's other considerations beyond just the money. So let's talk a little bit about the process of the fundraising, of setting up a successful fundraising process. I like to make sure that I like to make the analogy that, you know, a fundraising process is not drastically different than a sales process. You want to approach it in a similar structured manner, where you're going through a screening process, just as you would with sales, in order to get qualified leads. And then from those leads of the type of investor that you think matches, you match them, they match you, all of that. Then you want to try and connect with them so that you can actually contact them, have a conversation. And once you've connected, then you can actually pitch. And so it's essentially the 3-stage process. So let's delve in to this next part, which is talking about knowing the options and digging into the screen component of it. So who are the potential funders? One of the things that you need to be able to get an understanding of right when you're getting at this point is there are lots of different funding types. There's venture debt, there's grants out there for small businesses, there's loan programs, there's revenue finance. You have your more typical equity funding that can come through. So you want to have an understanding of what is the type of funding that you're really looking for, and ensuring that the stage that you're at matches the funding type that you're going to be looking for. If you're a pre-revenue company, revenue financing is not for you, because you don't have the first word of the type of financing. So you want to make sure that you have a solid understanding of what you're looking for. I'd imagine the majority of early stage companies are going to be looking for equity financing. It may be in the form of convertible notes, it may be in the form of preferred equity, it may be safe notes, it may come in a variety, but essentially the intention is that it's equity or equity-like. So you want to have that understanding of who the potential funders are, and then start narrowing down that list based upon who's providing the funding that matches what you want. Another thing is there's many types of investors. So being able to have an understanding of, if you're a social enterprise, look for impact investors. That's probably your best bet, because they're going to weigh your social impact along with financial gains. If you're a company that you think that you're going to be a rocket ship and just go straight away, then more standard venture capital is the type of investor that you should be looking at. So that's not an exhaustive list of the types of investors, but you can go through and kind of start to narrow that down in regards to understanding who you want this funding from, and narrowing it down. So once you've gotten to that and you've identified a few investors, now you want to say, okay, do you actually match their criteria? So that a lot of investors have kind of a check mark the box screen. Are you in the right industry? Do they invest in your industry? If you're a consumer goods company and you're approaching somebody that only invests in fintech, it might not be a fit. Here at Indelible, we focus on B2B. So if you're a consumer products company, probably not a fit. There's exceptions to all rules. So if you have something phenomenal and you really are set on an investor, you can still reach out. I just want to make sure that you're aware of going through this process, is to understand that if you do not match one of these criteria from the beginning, you're going to have to explain why they should be still interested in you, even though you don't tick this box on their checklist. Other criteria that they're going to be looking at is stage of company. Most venture capital firms have defined stages. At Indelible, we invest at the seed stage. So if you're a seed stage company, then we're going to be open to looking at you. And the stage of company is really closely tied to the size of check. So if you're somebody that's at a Series B, the size of check that you're looking for is going to be too large for a seed stage fund. You're going to max out what their average check size is. And so you want to be able to understand these criteria before you end up spending a lot of time, because it does take a lot of time in order to go through some of the process in order to get connected with an investor and then have these conversations. And then lastly, the other one that I'll jump on is in regards to the criteria. There's many different criteria, by the way. But another one here that I'll highlight is the geography. And so at Indelible, we focus specifically on Malaysia. And we do so because, for seed stage investments, generally speaking, investors don't go outside of their geography for that. And so you do want to have an understanding of whether or not the investor that you're looking for invests at your stage and in your geography. And again, you can still try and approach an investor if you do not check mark one of these boxes, but you're going to have to overcome that hurdle and explain why they should still consider you. So a lot of these are just making sure that you understand the areas in order to improve your likelihood, improve your probability of success. But there's probably instances where somebody will invest outside of their thesis, outside of their geography. So it's not a hard no, it's just something that you're going to have to fight a little bit harder for. Again, looking at the screening so that you can have a better understanding of who they are, you want to look at what have they funded in the past. So there's a lot of online resources. You can go through news publications, probably their websites have it listed. And you do this because for one part of it is just getting an idea of whether or not they're actually going to understand your business. Based upon what they've done in the past. Do they have the industry expertise in order to understand what you're going to do? It doesn't necessarily mean no, but it means that you may end up having to explain it in different terms than somebody that is an industry insider into what you're doing. And also, do they already have something that could potentially be competitive in their portfolio? Some VC funds invest in competitive companies and they manage their conflict of interest by having different team members or different ways of doing it. But it is it's going to be important for you to have an understanding of whether or not they're invested in anything that is potentially competitive to you, because it may preclude them from being able to invest in your business. Now, I will note that one of the complications when you're looking at what have they done in the past is that the investment teams, when you start getting below the general partner level, they may shift around. So an investment associate that works at one fund may have been at another fund and has deep experience in a certain industry that the firm that he's with now doesn't have if you look at just their current portfolio, but that individual has the experience. So there is kind of firm level and individual level due diligence that you should look into in order to have a better understanding. And again, similar to when you're doing a strong sales process, you're going through different methodologies in order to qualify these leads, in order to understand, are these high probability ones that I can convert? And then this last category here, I said that it's not just about the money. And it really honestly shouldn't be, because when you bring an investor onto your cap table, it's a long-term relationship. Average holding period is probably somewhere between 5 to 7 years. That's a long-term relationship, and you need to be comfortable with whoever you're bringing on. Actually, between 5 to 7 years, but it's actually extending out as companies stay private for longer. That's a conscious decision on behalf of the investors. But the point is that it can be a long-term relationship. And what's quite important is certainly in the beginning of that relationship, you want to have an understanding of how your relationship is going to function. And part of that is, what is the value that they will bring to you? Are they a value-add investor? Are they just somebody that invests in a very large number of companies? Are they doing it recreationally? Do they have some sort of strategy in order to provide value to the portfolio? And this can come in many forms. I've listed out a couple here, but it's certainly not an exhaustive list. One example is being able to be a mentor. We pride ourselves on being a mentor to all of our portfolio companies. We like to be that call when situations get difficult, to be one of the first calls for advice. Experience, it matters a lot. Somebody that's gone through the difficulties of scaling up a business to where you can call them up, rely on some of the experience in regards to how to expand internationally. What do I do in order to create a new channel partner? A lot of these different things of going through the growing pains, being able to have somebody with the experience that you can rely upon in order to give you the advice, etc., can be very important. As well as network. And recruiting, being able to find resources. So again, there's a lot of different types of value add that an investor can provide. So it's important that you look at what it is that you want. So let me just put this in a little bit of a different visualization for you. And so essentially, on one side, you're looking at who are the potential funders that you match. Do you match their criteria? What's their past funding? Are you a fit for them? Would you fit their criteria? And then you can narrow that down to a subset. And then you take that subset and you go over and you say, okay, well, who out of these folks are ones that actually match what I want? Do they have these other value add criteria that I want beyond just the capital? Because these other areas might be what enabled you to scale significantly faster and achieve the targets that you're getting. Because frequently it's about more than just the capital. All right, so you've screened them out. You've gone through all of this process in order to screen them out, and likely I hope let me back up. You should take all of that information there and put it into a spreadsheet. I highly recommend having an organized spreadsheet, or use a free CRM. I wouldn't necessarily say that you need to spend money on it, but it would be good for you to have some organized process in a spreadsheet or otherwise to where you can screen them down. And there are some free resources. And then you take that spreadsheet once you've narrowed it down, and then you bring it into this stage when you're looking to connect. And so when you're looking to connect, you're really trying to figure out, okay, how can I reach these potential funders? How can I reach this investor that I've now said is the one that I want? And the starting point with all of it, because a warm introduction is always better than doing a cold email or a cold call. If you can get referred in or get connected somehow, some sort of warm introduction has a higher probability than not. It doesn't mean that cold emails are not going to end up happening, because there are deals that are closed that way. But the best way to start is to go through and look at, who do you already know? You may already know some investors. You may already know fellow entrepreneurs who have been funded. So you might be able to talk to them and get contacts of either the fund that invested in them or funds that passed on them. You can look at your network of friends, family, your business community, and try and look at the power of that network. Who do you know already, and are they at all connected? Who do you need to know? Within the funds that you're looking at, you want to try and identify who the decision makers are. Oftentimes within venture capital firms, I'm going to talk more about that since my experience is in venture capital, and this is basically how our fund runs, is that you have different stages along the decision-making process. Oftentimes you'll have an analyst or an associate that is the one that sources the deal. They're the first point of contact that you have. They're the ones that you need to get excited about in the first place. And then they're going to take it onwards and present it to somebody at the partner level. And that's kind of the flow. If you can get to somebody at the partner level, fantastic, but you'll most certainly need a warm introduction in order to get there. Sometimes with the associate level or the analyst level, they're constantly out there trying to look for deals as well. So you might be able to get an inroad there, but certainly you want to have an understanding and try and identify who the decision makers are. Within your field, whatever the business that you have, there might be like ambassadors, influencers, important people within the industry that perhaps they're a thought leader, maybe they're a tech expert, whatever the case may be. You want to try and find out who is that sort of champion ambassador that you can connect with, who then could be like a super connector that ends up being able to attach you to their network and be able to introduce you out. So that's another key component when you're looking at this, is who are those connectors that are going to be able to get me to the decision makers or get me to these other people that I need to know. So how can you connect? When you've looked through your existing network of entrepreneurs, friends, family, et cetera, when you've looked at who do you need to know in regards to decision makers and ambassadors and so forth, you can start coming out with like a plot out of what are the degrees of separation that you have. Who can make an introduction for you? So jumping back to the kind of the spreadsheet tracker, have a column in it that says who can connect me. If you have multiple layers of the connections, who can connect to who can connect to who, but you want to try and look at it and really methodically identify those degrees of separation of how can you, if you put in the effort, get to that warm introduction in order to get in front of the proper person. Make use of your network. I hope that a lot of people within this space are the pay it forward type of people that would be very eager to provide you with an introduction. to be able to connect you. They may not facilitate the specific ask of what you're raising, but you'd be surprised at how quickly those networks can end up spanning out once you start tapping into it and looking for that introduction. But make it easy on your network. This last part about the forwardable email is quite important. You want to make it easier on your network if you're asking them for an introduction. So let's say that you come to me and say, hey, Kevin, I know that we fall outside of your space, but I know that you know so-and-so investor that is actually focused on my particular segment. I would love it if you could end up doing an introduction. So, okay, so you've done the ask, you've asked for the introduction. What's the next required step on my side? I either need to draft an email to send to this contact, or draft up a WhatsApp or whatever in order to facilitate that. And it's generally not done as simple as, hey, I think you guys should talk. Whoever I'm connecting you to is gonna want to have some understanding of why the heck are you sending me this contact? What is it about them? And so for you, who's asking me to do the connection, the best thing that you can do in order to not put a burden of time on me, making me think of a paragraph in order to type up, is do it for me. Send me a WhatsApp with a sentence or two of, we're doing this, and this, that sort of thing. You draft up an email that I can forward along with that ask of, hey, I'd love to introduce you to this person. It makes it a lot easier when you ask somebody for that introduction if you've done all of the work and all they have to do is press forward. So it sounds simple, but it's one of those things that simplify the process when you're looking for people to help you out. Okay, so now we end up moving into the pitch. And the key thing here is to be ready before you go. And so when I say be ready before you go, these are all like things that you need to have before you've actually even made the connections. But first and foremost, you want to have your story ready. Storytelling is a big part, and next week we'll talk about pitch deck and so forth. But when you're an early stage company, when you're looking for seed funding, angel funding, when you're at these early stages, you likely don't have enough traction in order to get somebody excited just off of the sheer numbers. And so the storytelling is the important aspect. Early stage investing is a people first business, in my opinion. And so you need to be able to convey why you and why now. What is it about you that makes me want to make a bet on you? And why is now the time for me to make that bet? And practice makes perfect. So when I talk about getting the story ready, I mean practicing it. There's an aspect of rehearsing. Find some people that you're friendly with. Maybe you're involved in some entrepreneur groups to where you have some friends that are in similar sort of conditions and similar positions, or maybe you have an advisory network or something along those sort of lines. You will get grilled. When you get to the point of doing a pitch, you will get grilled. People will ask you very pointed questions, and you're oftentimes only allotted a very limited amount of time. So you want to practice that in-person pitch of when you actually get to that point where you're having a conversation with a potential investor. You want to have that very well practiced. Not saying that you're to the point to where you're robotically reading things out, but you want to practice so that you're coming off well. But stick to the facts when you do this. I know I said storytelling is a big part, but I'm not talking about crafting some fictional narrative in order to get somebody on board. You want to be very factual and data-driven in order to convey the story. Not exclusively data-driven, but when you stick to the facts should end up being able to speak for themselves. Now, are you prepared to ask for funding? that jumps back. Are you in front of the right person when you're doing it? If you're not in front of the right person, change the way that you're approaching it. Sometimes there's a longer relationship building. You may not cut to the ask on the first day that you meet somebody. You may want to get that first conversation to where you're simply looking for a conversation, looking for advice. What are your thoughts on what's going on with the industry? Demonstrate that you can have a solid conversation around it. Sometimes that's the best inroad. Know who you're talking to. Have an understanding of who they are. Do some research on them, so that when you do get in front of them, you know that they're the right person. You know how to talk to them. You know what they're looking for. Craft it. Get ready for it. Okay, so what is it that they look for? What is behind, what are the wheels that are turning inside of the mind of an investor? This is where it gets a little bit of a little intense when you start getting deeper into this. So it's really important to be prepared and be organized. I keep on saying run it like a sales process, but it's true, because great salespeople are well organized, they're prepared, they are very effective when they come to it. And also understand, so while you're running your fundraising process as a sales process, they're managing a funnel too. They're not running it like a sales process per se, but they're managing a funnel. And so you need to understand that VCs say no more times than they say yes. A lot of them would love to say yes more often, because it's never fun to say no to somebody. But the fact of the matter is that a VC says no more times than they say yes. And so there's almost everyone's going to have a similar sort of funnel, to where there's those initial meetings, there's probably some follow-up. If you make it through there, they're going to do a little more basic analysis. If you make it through there, you can get into due diligence. If you make it through there, you're having those final partner meetings. You get to that sort of pass or go where you can get to a term sheet, but they're managing a funnel. And it's important that you understand that funnel, where you sit in that funnel, so that you can manage your fundraising process accordingly of where you sit in that decision-making process. And remember, you're selling your value. Again, most times with early stage companies, you're not going to have the necessary the traction. You are the product. You're selling your company. You're selling your value, and so you need to understand that when you're approaching it. So, okay, one of the basically the last thing that I'm going to touch on is kind of this thought process of what is a VC actually looking for. So I can't speak for every single VC that's out there, because everyone's a little bit different, and no two are the exact same. So what I'm going to go through is kind of the logic that Indelible Ventures looks at, which I think is quite a solid approach that you should keep in mind. So the foot in the door of what's going to get you that initial conversation is kind of the potential, the market size. Is the space that you're operating in big enough in order to get VC scale? Is it going to give the returns? Is it going to give the investor what they're looking for? If you've gotten your foot in the door, then the way that we look at things is we look at the people, the process, and the product, and we look at it in that order. And a lot of people will ask, okay, well, why do you look at the product last? And the answer to that is that this is a people-first business. When you're at the very early stages, you're basically in the middle of the jungle with no road inside, and you need to figure out where the heck you're going. Now, you created a compass, but you don't know which way is north. All of those sort of analogies play out, because the product will end up evolving over time. It's the people that create the product that can end up pivoting over time, that can navigate this winding road in order to find finally that dirt path out of the jungle in order to get to the highway. To extend that analogy, it's the people that do it. And so most VCs will want to get a high level of confidence on the people. And so what you need to be able to demonstrate is you need to demonstrate that there's a strength of that management team. Who's helming this? Who are the ones behind this endeavor? And do they have the requisite skills that is necessary? Do they have the domain expertise that is necessary? Now, when you're at the very early stages, you're not going to have all the bases covered of a full, complete management team, because that's just unrealistic for an early stage business. But you do need to be introspective enough in order to recognize your gaps and have a plan to fill those gaps. And so when you look at the people, you know, being an entrepreneur is probably the most difficult thing that anybody could end up choosing to do, because it's a 24/7 job. You need to have this unique combination of passion, of knowledge, and just sheer hustle. And so you'll want to make sure that you're able to demonstrate this when you're crafting your story and you're out there talking to investors. The next one is the process. Now, process, I'm not talking about any sort of like rigid type of process, because with startups, that's just unrealistic. What I'm talking about here is the types of feedback loops, so that you can move more quickly, get feedback from the market on how you're doing, and be able to grow and have that constant, continual process improvement. You know, do you know your customer? How are you getting feedback in order to better understand them? And how well do you know your value proposition? Are you getting those feedback loops so that you're getting response back, seeing whether or not that product market fit is playing out exactly as you initially envisioned? If not, are you adapting it? How are you changing it? What are the processes to review and revise? That continual process improvement gives that level of confidence that you'll have the ability to grow over time. And lastly, in the consideration is the product. You know, first off, you know, Indelible, we focus on companies that have some initial traction, that have demonstrated at least that initial point of product market fit. But the traction, when you're talking about it, when you're going out and having conversations with investors, when you're having conversations on traction, you need to make sure that it is very readily definable, attributable, and measurable. And you need to make sure that it fits clearly with the thesis that you're promoting of why now, why this product is what that investor needs to invest in, and why it's the future. And you need to be able to show that the traction that you have currently is repeatable, you can do it again, and scalable, that you can do it at a much greater volume going forward, whether that's expanding markets, whether it's expanding internationally, whatever it is, you'll need to be able to demonstrate that you can repeat it and that you can scale it. If you can show all of these characteristics, and be able to craft a story, you'll have a very solid pitch, and you'll improve your probability of being able to successfully raise. So before I wrap up and take questions, I just want to say a couple of wrap up comments here. Is that you really want to have a fairly methodic approach, treat it like a sales process, understanding who you want to raise for, how much you want to raise, why you want to raise it from them, when you need the money, and make sure and keep some sort of organizational structure around it. Whether it's a Google sheet, an Excel file, maybe you got a CRM, whatever the case may end up being. The more that you structure it and have a clear process defined on your fundraising, and you're organized, the more efficient you're going to be when you actually go out and fundraise. And if you do all of that, the person that you're raising from will likely see that you're running this process much more efficiently. So when you get to that sort of people, process, product, you're already demonstrating the people in the process in how you're approaching the fundraise. So with that, I want to say thank you to everyone for attending and listening to me as I've gone on for a bit of time now. If anyone wants to contact me, my email is right here, kevin@indelible.vc. And with that, I'd like to open it up to some questions. So perhaps somebody from Ross and somebody can see whether or not we have any questions rolling in.